Good evening, ladies and gentlemen, and this is Barry Norman on behalf of CMS Trader, and welcome to our class on Bollinger Bands. Now, tonight's class is sponsored by CMS, that's Capital Markets Traders, one of the world's leading providers of forex and CFD trading. Now, before you all ask, tonight's class is being recorded, and to see a recorded version of this class, all you have to do is wait about 24 hours and go to investing.com, who's providing this webinar tonight, where you registered to come to the class, look under webinars and go to webinars on demand, and you will be able to watch a recorded version of this in about 24 hours. Now, because CMS Trader is a regulated provider, I'm required to give you a risk warning, so let me read that and get it out of the way. Trading forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. Now, while you are in class tonight, if you want to take advantage of the CMS Trader platform, simply go to www.cmstrader.com, like you see on the top of the screen right now, and you can set up a free demo account. All you have to do is click on the buy or the sell button, enter an email address and select a password, and you will have a demo account ready so that you can use their charts on the platform to follow along and you learn how to use Bollinger Bands. Now, if you can't access the platform, it's not because there's anything wrong. It just simply means that CMS is not regulated in your home country and therefore does not provide services in your country, because CMS only operates where they are legally entitled to and where their regulatory licenses are issued to allow. So don't panic when you can't get there. It just means that they are not regulated in your home territory. Now, CMS Trader provides an excellent educational opportunity. They have impeccable service, guaranteed security. There's no conflict of interest between the broker and the trader, and there's no dealer intervention on traders. You trade what you want to trade, how you want to trade. You also get free daily signals, unlimited access to the trading platforms. You have free daily market updates and technical analysis, and ultra-fast execution. You can trade a wide range of instruments, including forex and CFDs for stocks, commodities, and indices. You can also take advantage of their very unique social trading platform and use their watch, copy, profit. Simply pick out the most successful traders that you are monitoring and watching, and then duplicate their trades in one easy click. You decide how much you want to invest, but you can just duplicate what they had. You take their stop loss, their take profit point, their entry level, the direction, and you don't have to do a lot. Just find the most successful traders on their platform and follow along. You can also learn how to become an independent trader with CMS Trader. You can take advantage of their video tutorials for beginners and professionals. You also get one-on-one sessions with a financial expert, as well as a huge library of ebooks. So let's get started talking about Bollinger Bands. Now, Bollinger Bands were created by a very famous, well-known money manager named John Bollinger. Now, Bollinger is still alive and well and kicking with us, and he operates his website called Bollinger Bands. Now, there are lots of people in the marketplace that have all kinds of discretionary theory of how to use Bollingers. But when the guy who developed it all those years ago and has been spending years crafting it is your best source. So if you want to learn any more after tonight's class, rely on Bollinger. Go over to this site, enjoy it, learn it, and master it. Now, Bollinger Bands were initially developed for the stock market, but have been adjusted over time to handle forex, CFDs, cryptocurrency, anything, and they work great in every market. Now, Bollinger Bands are one of the few indicators that are actually dropped on the charts right over price action. most indicators, most technical analysis are dropped below the charts. So there are very few that actually go on the charts over top of price action. Bollinger Bands is very unique. It fits in an envelope called windows or envelopes because it forms an envelope around the price. And Bollinger Bands uses what we call a lower band, an upper band, and a simple moving average band in the middle, and will tell you everything you need to know about the markets and the market condition. Now, Bollinger Bands, as I said before, can be applied to all financial markets, including equities, forex, commodities, and future. Bollinger Bands can be used in most time frames, from very, very short time frames to hourly to daily to weekly and monthly. So, depending on what your trading strategies are, Bollinger Bands are quite easily adjustable. And Bollinger Bands answers a very important question. Are prices high or low on the relative basis? By definition, price is high when it is near the upper band of the Bollinger Band envelope, and price is low at the lower band. That bit of information is incredibly valuable. It is even more powerful if combined with other tools such as other indicators for confirmation. So Bollinger Bands is a technical analysis tool. Specifically, they are a type of trading band or envelope. Trading bands and envelopes serve the same purpose. They provide relative definition of high and low that can be used to create rigorous trading approaches in pattern recognition and for so much more. Bands are usually thought as employing a measure of central tenacity, such as a base, such as moving averages, whereby an envelope encompasses the entire price structure. So standard Bollinger Bands is based on a very complex mathematical calculation that you'll never have to do. Now, look, I have my master's degree in taxation and finance. I have an undergrad in mathematics, and I couldn't calculate standard deviation if my life depends on it. Nobody does. In the real world, no statistician would ever calculate standard deviation by hand, but you have to kind of understand what it is. The calculations involved are somewhat complex, and the risk of making a mistake is high. Also, calculating by hand is very, very slow. Now, Bollinger Bands uses what's called a standard deviation of 2, and each band is created on that. What a standard deviation is, is a measure of a set of data. In its simplest form, the mean is simply the average of all the data points of a given set. So we accomplish standard deviation by calculating the base, is calculated based on the mean or the average. It's the distance of each data point from the mean is squared, summed, and averaged to find its variance. Okay, that's a big mouthful, isn't it? Or to put it another way, variance is derived by taking the mean of the data points, subtracting the mean from each data point individually, squaring each of these results, and then taking another mean of the square. Standard deviation is simply the square root of the variance. Now, what is this variance that we're talking about? Well, let me get back to a chart here for you. Bollinger Bands uses a moving average to make up the mean, because a moving average is just an average of the price. And then by applying a 2 times standard deviation, which is that complex mathematical formula, it then takes this average and calculates it out and gives us a point to plot on our charts. and it gives us one with a +2 deviation and one with a -2 deviation. So therefore, the upper and the lower band of the Bollinger Band are equidistant above and below the moving average. Because this band is 2 times the standard deviation, or 2 standard deviations from the average, which is the moving average. And this band below, the lower band, is -2 standard deviations. So the bands run in connection, upper and lower, based on this 2 times standard deviation plus or minus. The 2 times is set by Bollinger. So all the strategies you'll read about, all the information you'll get from Bollinger is based on his equation of 2 standard deviations. Now, this is very important because you can adjust the standard deviations. Like I use a 2.5 only because I want the smallest amount of signals with the highest accuracy. But I have had to test that at 2.5. But 2 is the default, and that's where you should stay until you've used it enough that you can then test and back test any other deviation if you like. But changing, and I'm just going back to the chart here. So basically, we have this moving average, and we've added, again, +2 standard deviation, and we create the upper band, and a -2 deviation, and we correct the lower band. So these bands right here and right here are equidistant from this moving average line. So I'm going to show you in a second from now how to put this on your charts. Because it's very easy. You have to understand what these calculations are. But to understand the mathematics is well beyond you and me together. And we don't have to do the calculations because Bollinger Bands is such a popular indicator that it is on all charts easily available. So let's go over to a live chart and let's see how we might do this. So we're looking at a live chart for the Euro-US dollar in a 1-hour chart. I'm going to get off the MACD that I have down here. And so now we're looking at this simple price chart, 1-hour price chart. We're going to go up here to indicator. We're going to scroll down here to Bollinger Bands. And look at that. It's all done for us. We didn't have to do any calculations. Now, if we want to go back and see exactly what this is, let's go up here and click on Bollinger Bands and the format. And I'm going to make this a little bit easier for you. The basis line, which is the moving average line, I'm going to make, let's see, what color do we want? We're going to make it a dark gold. And we're going to make it very thick so it's easy for you to see it. And you can see that is a 20-period moving average. So in this case, we're looking at a 1-hour chart. So it's based on 21-hour closes. Okay. If we were using a 15-minute chart, it would be 20 15-minute candles. If we were using a 1-day chart, it would be 21 days or back 20 days. And then we're going to make the upper and the lower band bright red, only so you can see them better. You can pick whatever colors you want so you understand what they are and fit into your charting. And we're going to leave the background in whatever color it is right now. And what we see is the upper and the lower band in red and the moving average line in gold. Okay. And the background in a greenish shade. That's all we had to do. And once we've set this up as how we want our Bollinger Bands to be put on our charts, we no longer have to set that ever again. And like I said, I just set the colors that make it easily visible in class at the moment. That's, you select what you want because you can't change this overall Bollinger Band. You could change the standard deviation to 2.5 or 3. You could change the moving average to 25, but then it's no longer Bollinger Band, it's Barry's Bands. Because I'm no longer using John Bollinger's formula. So this is how we put the Bollinger Bands on the chart. And they say that every piece of information a trader needs is available in the band. In between these bands, we'll find entry points, exit points, stop loss, take profit points. That's kind of amazing, isn't it? Now, we have this band on the charts. Now, the question is, how do we read it? Well, the first thing everybody says to me is, well, what does the shape of the band tell us? Well, there's very little information based on the image that you get from the band or the envelope. And you get some weird shapes and weird sizes. What you do see is the volatility in the market. When the markets are volatile, like they are right now at the moment for the euro US dollar, we see a very wide band. Okay. If the bands contract, means the markets are contracting also. So you can see here a narrow band, and we don't see much price action. Okay. So that's the only thing we get out of the distance between the upper and the lower band. We get, or the visual imagery that we see of the width of the band. So right now it looks like a snake. Sometimes it looks like an alien. Sometimes it looks like, God knows, some of those things that the psychiatrists give you, what they call Rorschach tests. But that is the only value we get from the actual band itself. Because what we're concerned about isn't the band and the shape of the band. We're simply concerned with the upper band, the actual upper band, this red band, and the lower band. Okay. This is where all of our telling clues are, and the moving average line here. Now, the moving average simply takes the noise out of the markets, shows us where the trend is going. And in Bollinger Bands, gives us a little bit of hint about what we should be doing above or below the moving average. But now that we have it on the charts, let's go back and learn a little bit about how we would use this in our trading. So let me take you back to the PowerPoint. And let's pick up from where we left off. So we now know how to calculate it. We know how to put it on a chart. We know how to color code it. And we know basically what it is. There's a bunch of squiggly lines on a chart. So Bollinger Bands uses 3 lines. The baseline, which is the middle band, and it's usually a 20 base or 20 period moving average. The upper band, which spread above the moving average by a volatility measure known as standard deviation, and the default is set at 2 standard deviations. The lower band, the middle band, is the middle band less the same lower band, or the middle band less the same volatility measure. Okay, so we see that on the charts. Okay, now, from this on the charts, we get 3 vital pieces of information, or we have 3 uses. 1, we get pattern recognition. 2, we have reversal signals. And 3, we have trend analysis. So under pattern recognitions, we look for double tops, head and shoulders, and double bottoms. This will tell us something about the market. Then under reversals, we get early warning signals of when a market is about to reverse. And lastly, by doing trend analysis, we can detect whether a trend is in continuation or at its conclusion. So let's talk about one of the most popular ways to use Bollinger Bands in your trading assessment. And this is looking for patterns. Now, we know what double tops are and double bottoms are because we look for these in price movement anyway. Well, we look at these between lines of support and resistance. We look for these all the time. Now, in a Bollinger Band, this pattern is formed within the band. So what we're looking for is the price, whether we're looking for a W or an M, because a double bottom forms what looks like a W because you have two bottoms and you have the four supporting axes or the four supporting lines. And the opposite is of a double top, which gives you an M shape. But what we're looking for in here is the crucial, what we call the N. It's either a right side up N or an upside down N. Because you don't want to spend all day looking at Bollinger Bands trying to find this W when it's already taking place. You want to spend hours because it has no value and no meaning until it's formed the second bottom and is moving towards a top. So once it's formed the N, it might be worth you spending some time on. Otherwise, you don't need to spend any time on because nothing's happening. So you have a bullish bottom pattern is formed by two successive bottoms in the price action, which typically resemble a W. Okay. Although at the first it will resemble an upside down N. Is what we see on, oh, I lost my, there we go. Is what we see right here on this chart. Okay. It actually forms a W, but we first see this N. Okay. The key lies in establishing bullish positions near the lower Bollinger Band with a target set for the upper Bollinger Band. So once it forms the N and forms the second bottom, we would wait for it to bounce off of there, and we would look to establish some buy positions as it moved up, especially when it crossed the moving average. We would set our profit point at the upper target, and we would set our stop loss at the swing low below the moving average. Now, a bearish top, which is just the opposite, is formed by the successive tops in a price which opposite to the W form an M. Before forming the entire M, an N will emerge in the price action, and this is the point at which traders will want to get involved. So what you want to get involved is when the N is completed and is moving to form that last movement of that W or the M, that last leg, and you would want to then enter, whether it's, if it's an up movement, a buy position, if it's a down movement, sell position, using the moving average and the opposite side of the band to make your to use for your risk analysis and your risk points and your take profit points. So when the second peak of the N has formed by the price action, by the asset price action, it's time to establish a bearish position in a trading asset. Should prices continue to rise after the fact and move higher above the second top, it is a signal to exit and wait for new opportunities. Now, this is a very it's not a very technical, complicated pattern. But when you combine this Bollinger Bands with RSI indicator, it becomes a perfect match. And there are two types of tops that you need to know about. And when you see these form, okay, and getting the support of an RSI indicator, you can then start moving into action. But you always want to be aware of where the trend is when this is happening. So after a trend move, price fails to reach the upper band as the uptrend becomes weaker. This signal is usually accompanied by an RSI divergence, which is a continuation signal. During a consolidation, price spikes to the outer Bollinger Band, which gets rejected immediately, and reversal signals in, and I'll show you this in the charts in a minute. So what we're looking for is, again, tops, and the tops also can be bottoms in the exact opposite way, unable to breach the future tops and unable to reach the upper or the lower band. Combine that with RSI and you get very good signals. Now, when you use this with the moving average, you can then decide or make some very good, or combine it into a very good strategy. So during trends, the moving average holds very accurately, and a break of that moving average is usually a meaningful signal that the sentiment has shifted. During the trend, the moving average could have been used as a re-entry signal to add to existing positions during pullbacks. Furthermore, the moving average can be used as a trade exit signal where a trader does not close his existing positions unless price has broken the moving average. By combining Bollinger Bands with the moving average, a trader can already create a robust trading method. So as we can see on this chart right here, we see price moving up in an uptrend. And at this point, when it breaks above that moving average, okay, it's telling us that we should be entering a long position. And we could have ridden that long position all the way up. Now, what happened at this point? Rode the position, and this is called riding the band. When price sits right on the band, touch the band, okay, we're riding the band at that point. But what happens when price eases back down, stays above the moving average, pushes up to form new highs, but then eases back down and is not able to reach that band again, and then fails again to reach that band and breaks the moving average? It's telling you that trend is over, buddy. And what happened? It broke that moving average, and this is the point you should be exiting the market, and actually in this case, entering the exact opposite direction, because not only did it, this is the point that's telling you that that trend is over, when it cannot reach the upper band again. And when it crosses that moving average, if you're still in the market, you want to sell. And if you're not in the market, this is your sell signal to enter the market for that downtrend. Now, while Bollinger Bands are exceptionally helpful in determining when an asset is overshot to the upside or the downside, it's important to use the band to also set risk conditions, not just entry points. Additionally, risk and reward should be set based on the width of the bands or the volatility, with narrower risk reward during a low volatility period and wider risk reward during high volatility periods. So in contrast to most other indicators, the Bollinger Bands are a non-static indicator, and they change their shape based on the recent price action and accurately measure momentum and volatility. Thus, we can use Bollinger Bands to analyze the strength of trends and get a lot out of what they have to say. So let's take a look. What do we see here? We've got our Bollinger Bands on our USD Canadian dollar chart, and we're watching price movement. Now, granted, what happened back here doesn't help you trading here. Okay. What happened here doesn't really help you trading, because you can only trade at this point going forward. But you have to be able to read the bands to have any idea what they're trying to tell you up here. So let's see, as we're moving along here, and as price is moving, you were starting over here. Okay. As price is starting out the day, you drop your Bollinger Bands on your chart. Now, they haven't formed all the way up to here because right now we don't have the price action. So we would be using the past, but as we start, we see the moving average on the just trying to get my marker back in. We see the moving average on the chart. We see the bands just teetering on that moving average. We see the moving average climbing up. Price is climbing up. And what is the first thing we see? We see price here make a swing high, trying to reach that upper band and unable to reach it. Then we see all of these new higher, lower highs, unable to get anywhere near that upper band. Price dips below that moving average. Well, it's telling you that upward movement is over, and we're either going to move into a period of congestion or move to a downtrend. Well, here we moved into a downtrend, and now we got what we call riding the bands, where price is staying right on those bands as it is moving down. So we could have entered a very strong trade, a sell trade, anywhere at this point. Again, as price moves down, we see it create a new swing low, but is unable to reach that band again, and bounces off and starts moving up, because that tells you the sellers are now no longer in control and they're not in the market because they weren't able to touch that band. Again, it moves up and breaks that moving average price, we might have considered entering a buy signal here. It's not a very obvious buy signal, but then we could have ridden the band up to here. We see the price continuing making higher highs touching that band, and all of a sudden it bounces off the band and then tries to make a higher high but can't come near that band again, falls down and breaks that moving average. And even though it broke below it and moved right back up, it's still not able to get anywhere near that upper band, and falls back down, breaks that moving average, and moves into a very, very strong downtrend. Again, over here, we then recede in off that lower band, and in this case, we went into a very small little uptrend, and again. So we can tell a whole story between the moving average lines and the upper and the lower band. Because remember, as I told you, we're not concerned with the band shape. We're concerned with the upper and the lower band. So again, as price is in a strong downtrend in the very beginning, price stays close to the outer bands all the time. That's a very bearish signal. Then price fails to reach the outer band and then shoots up very strongly, even showing an engulfing pattern. This is a classical reversal pattern where the bearish trend strength faded. Then three swing highs with lower highs. The first swing high reached the outer band, whereas the other two failed to reach the outer band. So let's go back over to that chart and let's go map 1, 2, and 3 again. Okay. So as price started out that day, it's right on the upper moving average, and it moves above, but is unable to get towards that upper band at all. Breaks the moving average, and then it forms that bearish signal, which gives us a very good downtrend. Here it goes into 2, where it tries to reach the lower band, but isn't able to. Gives us a bearish engulfing signal in the candlesticks, if you understand what those are, and then moves into an uptrend. An upward price breaks above that band, which would have given you a buy signal, but then it moves up, and here we get the touch of the band, the bounce off of it, unable to reach that band or set a higher high, breaks that moving average and moves back towards that upper band. It's unable to do anything and moves into that downtrend. So that was 1, 2, and 3 on our explanation over here. Then in 4, we moved to a strong downtrend where price stayed close to the outer band. It pulled away, but bears were always in control. Then 5, price consolidated sideways, not reaching the outer band anymore, and the rejection pin bar ended the downtrend. So again, 4, straight down staying near that lower band, then moved into congestion. It just stayed in the center of the band. Okay. Then formed up here and formed a very good downtrend, broke the moving average, flowed all the way down. Then we got the pin bar right here that's unable to reach the band and then moves into sideways congestion. So you can actually tell an entire story using simply Bollinger Bands. And it's not very complicated. So John Bollinger created the %B, which is a little bit moved farther with his Bollinger Band. It's an indicator that depicted where price was in relationship to the bands, and then he added bandwidth to depict how wide the bands were as a function of the middle band. And for many years, the state of the art was Bollinger Bands with the %B and the bandwidth. %B is an indicator for measuring the distance between the Bollinger Bands. Appropriately, this indicator is called the Bollinger Band width, or just the bandwidth indicator. It's simply the value of the upper band less the value of the lower band. Understandably, so that tells you how that number, which is the %B, just simply tells you the volatility in the markets. The higher the %B, the more volatile the markets. The lower the %B, the more contract the markets are. %B is an indicator derived from Bollinger Band and quantifies the security's price relative to the upper and the lower bands. So let's not freak out. There's nothing we have to calculate. We can simply drop it on our charts by looking for under indicators and looking for the Bollinger Band's %B and add that to our charts. So all we've done is gotten one more derivative or one more use of the Bollinger Band. So it drops it below the chart. And what Bollinger did was we didn't actually subtract the upper and the lower band. We assigned values to the upper and the lower band. And when the price remains in the middle of the bands but below the upper band, it's given a 0.5. When it breaks above the upper band, it's given a 1. When it falls below and is by the bottom of the band, it's given a minus point. It's given a minus 0.5, and when it breaks out of that bottom band, it's given a value of minus 1. And those are then just plotted on the chart down below, and it's telling us the relationship of the price to the upper or the lower band. So ideally, when buying a security, we want the percent B reading to be below 1.1 for multiple days. So when you're trading with Bollinger Bands, and especially the percent B component Bollinger Bands, you want to be as structured and rule-based as possible. So let's get to the rules for good trading. The rules are generally the same for each market, but you need to set the right levels for the market. And there are easy ways to get these on the internet from just going to Bollinger Bands website, www.bollingerbands.com. Successful day trading is mostly a game of pennies. The best firms and individual day traders who look to scalp in small amounts using Bollinger Bands and percent B show that intraday edges do exist. The larger day trading firms look for edges as little as 0.1%. Individual traders need larger edges, and those edges are often difficult to find over longer term periods. By using Bollinger Bands, though, we can see that these edges, or moving things, the odds in your favor, have existed for over decades. So as you can see, knowing how to exit Bollinger Bands trade is as important as knowing when to enter one. But looking at various precise exit tools, you're able to make variations with high averages. Successful day trading is mostly a game of pennies. So Bollinger Bands, especially the percent B calculation, have been large qualified edges when you trade them in a systematic manner. There's a precisiveness here using Bollinger Bands. In this way, you can use this precisiveness to your advantages. Okay. Now there's hundreds of potential variations. Okay, there's all types of strategies and theory you're going to find in the market for gurus pushing their interpretation of how to use Bollinger Bands. Now that you know how to put them on your charts and how John Bollinger wanted them to be read, you can then apply different strategies. One of the most popular out there is called the Bollinger Band Squeeze. And the Bollinger Band Squeeze is a straightforward strategy that is relatively simple to implement. First, look for securities with narrowing Bollinger Bands and low bandwidth levels. Ideally, bandwidth should be near the low end of a 6-month average or 6-period average. Second, wait for a band break to signal that the start of the new move. And a band break means the price either breaks out up or down above the band. An upside band break is bullish, while a downside band break is bearish. Note that narrowing bands do not provide any directional clues. They simply infer that the volatility is contracting and charters should be prepared for a volatile expansion, which means a directional move. So watch the bands and watch for price to break out of the upper or the lower bands. So when price surges above the upper band, that's giving you a clue to enter in a buy position. When price breaks below the lower band, you would consider entering in a sell position. But you need other indicators. So the second is we want to see bandwidth declines to the low end of the range. So like here where you see a breakout below, you have nothing with the bandwidth indicator. So it's not a signal. Here we have this beautiful break above. You're getting the low end of the ranges for that Bollinger Band, and it's giving you a signal. Now you can't do this blindly. You have to combine them with other indicators. But remember, keep your eye on the bands, look for breakouts, look for breaks above and below the moving average, and look for ways that you can use this information. So even though the Bollinger Band squeeze is straightforward, charters should at least combine this strategy with basic chart analysis to confirm signals. For example, a break above resistance can be used to confirm a break above the upper band. Similarly, a break below support can be used to confirm a break below the lower band. Unconfirmed band breaks are subject to failure. Because the Bollinger Band squeeze does not provide any directional clues, chartists must use other aspects of technical analysis and confirm a directional break. Now, as you can see, the Bollinger Bands are a multifaceted trading indicator that can provide you with lots of information about trends, buyer-seller balances, and the potential trend shifts. Together with moving averages in the RSI, Bollinger Bands makes for a great foundation for any trading strategy. And on that note, I'm going to say goodnight to y'all. But what I would recommend is go to www.bollingerbands.com and learn from the master, learn from the man who developed the strategy, and follow along. He's got videos, he's got interviews. I mean, he's still alive, so he's still practicing the market. He's got all kinds of strategies, and follow along and enjoy his knowledge. Thank you very much, and have a great trading day. Bye now.